Hello, welcome back. You thought you could get rid of me. You can't, like the trauma from a stop loss that's been run over many times. Anyway, welcome back. Enough of my trauma. If you've been looking at the stock market lately, like me, pondering, wondering, lamenting, and thinking, this feels less like finance and more like a fever dream I had after eating some bad sushi, then you're not alone. Today, we're going to be discussing the European Central Bank's latest stability review. I know, exciting stuff. Exciting stuff. It's almost like watching intellectual paint dry, but I assure you, this one is special. This report feels a lot more like something that should concern investors. The market isn't just stretched right now, it's doing yoga, according to the ECB. It's like the 17th century tulip mania. We have companies adding the GDP of entire countries on a daily basis. So today, we're going to be breaking down the charts, the panic, and the undeniable math that suggests we are one earnings report away from a disaster. Let's start with the ECB. The European Central Bank just published a report that basically reads like a hostage note. Now, central bankers are trained from birth never to use clear language. There's always obfuscation and inscrutability, esotericism, if that's a word. We are observing elevated inbound rocky risk to the trajectory pathway of the interest rate trajectory inflationary quagmire. Translation, your portfolio is currently standing on a ledge, and the ECB is the guy with the megaphone yelling, do a backflip. They specifically pointed out the concentration in US top stocks. They are begging investors to stop buying NVIDIA, stop talking to their Make Crypto Dave, and to start thinking about something more logical. They've explicitly warned about disappointing earnings could be a trigger for repricing and that NVIDIA et al. Are overpriced. Now, you never really see or hear the candor from a central bank like that, so that's something that we should look into a bit more. Well, let's look at the numbers, shall we? Because math, unlike market sentiment, doesn't care about your feelings or your opinion. This is what we call a cry for help. Look at the price to sell ratios of certain companies in the S&P right now. It's not 3.2, it's like 55.2, right? NVIDIA is trading at multiples that suggest it has already colonized the galaxy and it's selling GPUs to Plutonians, to Martians, and Jupiterians, whoever those people are. They developed the formula for turning alchemic lead into gold, which they haven't. Now the bulls will say, but this time is different. Yes, AI is real, and yes, it's going to change the world, but this is just the Cisco Systems moment. The chart from the early 2000s that had everyone saying this time is different. In 2000, Cisco was the shovels of the internet, right? The gold rush. Everyone needed routers. Cisco was the most valuable company on earth, and it was like trading like nothing, nobody's business, right? We are partying like it's 1999, except the prince now we have is Sam Altman. And he's promising all of the fixes, the fixes of world hunger, of poverty, of the climate change. But is it really turning into bankable profit? Well, let's talk about the market structure, because this isn't just a stock market anymore. It's 7 tech companies in a trench coat pretending to be the economy. And no one's looking under it. Thankfully or unthankfully, I don't know. Look at the magnificent sevens waiting now. They make up nearly a third of the S&P 500. This is what the ECB is calling concentration risk, which basically means all of your eggs in one basket, mixed in together with like C4 explosive, right? Most of these companies are just buying the index. If NVIDIA goes up, they have to buy more of the index. It goes in more, it's more cyclical, it regurgitates. But this could also work in reverse. If these stocks start to fall, the passive funds also have to start selling it, right? If the Max 7 starts to sneeze, your 401k or your equivalent in your country starts to catch the most prodigious bubonic plague. And that's why the ECB is warning of it in terms of like systemic risks, right? So where are we in the cycle? Are we at the peak of inflated valuations and expectations? Or is this the moment where our driver in the Uber starts to talk to us about large language models? No offense on the Uber drivers. I've met some brilliant Uber drivers in my past. In fact, I'm going to take that phrase back. Is this the time when you start to look to your cat or dog to ordain whether or not you should be more heavily invested in NVIDIA? From a technical perspective, your cat might be saying the indicators aren't just flashing red. They are screaming. They're sweating. They're asking you for a lawyer. The RSI levels are elevated to what would normally precede a crash. The fear and greed index are elevated, and they're basically saying we are way too over the cliff and we're running on empty. And the fuel for this fire, well, is it zero DTE options? Probably. It's not investing. It's just casinos inside like a dumpster fire, right? Retail traders are throwing money out of the window and their calls are just expiry money. It's reckless options trading, market makers forced to buy the stock goes up, retail buys more option, gamma squeezing, gamma pinning, and the cycle continues. A perpetual motion machine until the momentum stops. So while the stock market is doing lines of something in the bathroom, the real economy is sitting at the bar wondering how it's going to pay the tab. Just look at the divergence. The stock market is pricing in infinite growth forever. The real economy is dealing with sticky inflation, high interest rates, and the consumers who are running out of money. And credit card delinquencies are going up, not to mention student loans and auto delinquencies as well. And where is the elephant in the room? Well, we all know what it is. It's the US debt load. The ECB politely mentioned that sovereign debt is also a concern. Let me translate that. The US money is spending money like a drunken sailor who stole a credit card and has no way of paying it back, and the mortgage is coming due for $100 trillion in 10 days. That's what I call sovereign risk, which the ECB very generously termed as specific sovereign risk. Well, we all know who they're talking about and what it means, right? So what actually will end up popping the bubble? Because it's not going to take much at these overextended stretch levels. It's never the thing you see coming. Like, it's never the thing you expect it, right? Maybe it's a typo in an earnings report. Maybe Powell sneezes during a press conference. Maybe the algos would interpret it as a rate cut. Or maybe like some, I don't know, live demo or presses on a button or some fat finger initiates something way stupider than we ever thought would be possible, right? Like the catalyst is always something that you never really expect, and then retrospectively some people are like, oh yeah, I knew that in hindsight, right? We are here. We're in the new paradigm phase. Earnings don't really matter anymore because AI changes the fabric of time, space, and the continuum. But spoiler alert, earnings always matter, and gravity is real, and valuations always come back in line. Remember, liquidity is a coward. It disappears when you always need it most. The market depth right now is super fragile. That means when everyone rushes for the exit at the same time, they're going to get crushed by the door that can't accommodate all of them, right? So the ECB lays out 3 scenarios. Number 1, utopia. AI saves us all. Number 2, the soft landing. We're going to get extremely lucky. And number 3, we told you so. It's a meltdown. Batten down the hatches. We hope you diversified. So we are actually living in a Brussels ECB's case study that economists will probably teach for the next 50 years. And the class is probably going to be called, Why Did We Ever Think NVIDIA Was God? Right? Look, maybe I'm wrong. I don't know. Maybe I'm wrong. Maybe I'm right. Maybe stocks go up. Maybe stocks go up exponentially, parabolically, forever and evermore. Or maybe they don't. And maybe they come back down like they always do, and they mean revert. And the new technology isn't the thing that we thought it was. It's not like the train didn't save the world. The internet wasn't what it was thought to be. The North Sea bubble, the tulip mania, the gold rush, all of these things didn't ever come into fruition and didn't ever generate the seismic changes in our society as they thought they would be. But maybe I'm wrong. But if I'm not wrong, it doesn't really hurt to de-risk, stay liquid, and to keep a bit of dry powder on the side. And that's always my mantra. Not my mattress, but a mantra. And your raison d'etre should be to survive. Because in this game, you have to have the chips to play, right? They put all of your eggs in one basket mixed with C4. And you're not going to get egg on your face. But that's all I've got to say for today. Ciao for now. See you on the next time. I'm Justin Benton. Almost forgot. Like, share, and subscribe. Ciao for now.